What if I told you there's a way to save up to $72,000 per year in a tax-free retirement account? Not $7,500 like a Roth IRA, not $24,500 like a regular solo 401k. Up to $72,000 that grows completely tax-free. It's called the Mega Backdoor Roth, and as a freelancer, you have a unique advantage that most W-2 employees don't. In the next 8 minutes, I'm breaking down exactly what the Mega Backdoor Roth is, how it works with your solo 401k, and how to set it up in 2026. Note: this information applies to US-based freelancers and self-employed individuals. Welcome to the Freelancers Wealth Blueprint. Let's unlock your tax-free retirement potential. First, let's understand why this strategy exists. You probably know about Roth IRAs. You contribute after-tax money, it grows tax-free, and you withdraw it tax-free in retirement. Amazing deal. The problem? The contribution limit is only $7,500 for 2026. And if you earn too much, you can't contribute directly at all. The Mega Backdoor Roth solves both problems. It lets you contribute up to $72,000 per year to a Roth account, regardless of your income level. Here's how the math works in 2026. The total limit for all contributions to your solo 401k is $72,000 if you're under 50. That includes everything: employee contributions, employer contributions, and something called voluntary after-tax contributions. Most people only know about the first two. Employee contributions max out at $24,500. Employer contributions can be up to 20% of your net self-employment income as a sole proprietor. But there's often a gap between what you contribute and that $72,000 ceiling. The Mega Backdoor Roth lets you fill that gap with after-tax dollars, then immediately convert them to Roth. Let me give you a concrete example. Say you're a freelancer earning $150,000 in net self-employment income. Your employee contribution, $24,500. Your employer contribution, roughly $27,800, which is 20% of your net income after the self-employment tax deduction. Total so far, about $52,300. The overall limit is $72,000. That leaves roughly $19,700 of unused space. With a Mega Backdoor Roth, you contribute that $19,700 as voluntary after-tax dollars. Then you immediately convert it to your Roth account. Now that money grows tax-free forever. If you're 50 or older, the numbers get even better. With catch-up contributions, your ceiling is $80,000. And if you're 60 to 63, it's $83,250. Here's why this matters so much. Most freelancers I talk to max out their Roth IRA at $7,500 and think they're done with tax-free savings for the year. But the Mega Backdoor Roth can add $20,000, $30,000 or more to your tax-free retirement savings. Over a career, this adds up to hundreds of thousands of extra dollars growing tax-free. Let's say you contribute an extra $20,000 per year through the Mega Backdoor Roth for 20 years. At 7% annual returns, that's over $870,000 in tax-free retirement money. If you're in the 24% tax bracket in retirement, that's roughly $210,000 you'd never pay in taxes. Now here's the catch. Not all solo 401k plans support this strategy. The free solo 401k plans from major brokerages like Fidelity, Vanguard, Schwab, and E-Trade do not allow after-tax contributions. They only support pre-tax and Roth employee deferrals plus employer profit sharing. To use the Mega Backdoor Roth, you need a solo 401k plan that specifically allows three things. 1. Voluntary after-tax contributions as a separate contribution type. 2. In-plan Roth conversions, meaning you can convert those after-tax dollars to Roth while the money stays in the plan. 3. Separate accounting to track the after-tax contributions apart from your other money. Providers that offer this include companies like My Solo 401k Financial, Carry, and a few others that specialize in self-employed retirement plans. These typically cost between $100 and $500 per year, but the tax savings can be enormous. Let me walk you through the three-step process. Step 1. Make voluntary after-tax contributions to your solo 401k. This is money you've already paid income tax on. You're just putting it into the retirement plan. Step 2. Convert those after-tax contributions to Roth. You can convert them to your solo 401k Roth account, which is called an in-plan conversion. Or you can roll them out to a Roth IRA. Step 3. Enjoy tax-free growth. Once the money is in a Roth account, all future growth is tax-free. Withdraw it in retirement without owing a penny. The key is to convert immediately after contributing. If you wait and your after-tax contributions earn investment gains, you'll owe taxes on those gains when you convert. Convert right away and the tax bill is essentially zero. Here's an important consideration for 2026. If you run your freelance business as an S-Corp and pay yourself W-2 wages over $150,000, there's a new rule affecting catch-up contributions. Starting in 2026, your catch-up contributions must be made as Roth contributions, not pre-tax. This doesn't directly affect the mega backdoor Roth strategy, but it's worth knowing if you're using both strategies together. Let me address who this strategy is best for. The mega backdoor. Roth makes the most sense if you're a high-earning freelancer. You need enough income to max out both your employee and employer contributions and still have money left over for after-tax contributions. Practically speaking, you probably need at least $120,000 to $150,000 in self-employment income to meaningfully benefit. Below that, your employer contribution limit restricts how much after-tax space you have. It also makes sense if you value tax-free retirement income. If you expect your tax rate to be similar or higher in retirement, getting money into Roth accounts now is incredibly valuable. And it works best if you have the cash flow to contribute. This is money you can't touch until retirement without penalties, so make sure your emergency fund and other priorities are covered first. Here's the step-by-step to set this up. First, evaluate whether you need to switch providers. If you have a basic solo 401k at Fidelity or Schwab, you'll need to open a new plan with a provider that supports after-tax contributions. Second, establish the new plan before year-end. To make 2026 contributions, your plan needs to be in place by December 31st, 2026, though the actual contributions can be made until your tax filing deadline. Third, calculate your maximum contribution. Add up your employee deferral and employer contribution. Subtract from $72,000. That's your after-tax space. Fourth, make your contributions throughout the year or as a lump sum. Fifth, convert to Roth immediately after each after-tax contribution. Let me give you a real-world scenario. Marcus is a 45-year-old freelance software developer earning $200,000 per year. Here's his 2026 contribution breakdown. Employee deferral, $24,500. Employer contribution, roughly $37,000, which is 20% of his net self-employment income. Total so far, $61,500. His after-tax space, $72,000 minus $61,500 equals $10,500. Marcus contributes $10,500 as voluntary after-tax, then immediately converts to Roth. Combined with his $7,500 Roth IRA, Marcus puts $18,000 into tax-free accounts this year, on top of his $61,500 in tax-deferred retirement savings. If he does this for 15 years until age 60, those mega backdoor Roth contributions alone could grow to over $280,000 in tax-free money. Here's the bottom line. The mega backdoor Roth is one of the most powerful retirement strategies available to high-earning freelancers. It lets you contribute up to $72,000 or more to tax-free Roth accounts, far beyond what a normal Roth IRA allows. The catch is, you need a specialized solo 401k provider that supports after-tax contributions and in-plan conversions. The free plans from major brokerages won't work. If you're earning over $120,000 as a freelancer and want to maximize your tax-free retirement savings, this strategy deserves serious consideration. If you're not quite at that income level yet, check out our videos on building wealth at $75K and $100K to help you get there. Links in the description. See you in the next one.